So here's the thing you got to understand. This is not a get-rich-quick thing. This takes time. This is not about a product, folks. This is about a process. Therefore, it becomes uninterrupted compound interest, something that most people have no idea how to achieve.
It's just a different way of looking at money. And when you've been taught something your entire life and it works one way, and then all of a sudden somebody's like, actually, you're kind of wrong about it. And, it's hard for somebody to change that mindset.
What's up, everybody? It's another week, another wealth webinar. I got myself and my partner in crime, Mr. Snaggy, and today we've got an unbelievable training. One that will test your mind and your math skills, I promise you. Because how we came up with the idea to do today's wealth webinar and what we're going to talk about largely is because of current events, things happening. Is it China invading Taiwan? Hasn't happened yet, but looks like it's brewing. You got interest rates going up. And along with interest rates going up, you got the banks paying you a little bit more in interest, but charging you a heck of a lot more. What does all this mean? How is it all going to impact what you're doing and what we teach every single day, which is for you to take back control of your money? And I can't think of a better time, Stephen, than right now to get people to take back control of their money. Banks are failing. Everything seems to be just kind of falling apart in one way or the other. And now we get to make our stand. And our stand has to start with the dollars that we have in taking back control. And the best way I know to do that is to teach you a process which allows you to become your own bank. And that process is called the infinite banking concept. Pioneered by the late R. Nelson Nash, made famous by his book, Becoming Your Own Banker. Those will be the baselines for today. But as I've said numerous times in the past, when I'm doing these trainings and I'm constantly bringing up the simplest things of mathematics, I'm always surprised when people, are trying to look at it and do the math, and most people get it wrong. So what I've got is this thing, and a lot of you have already seen it. I'll pull it up in just a second here, but it's going to show you the mathematics behind something that today we're really going to unravel. But let me transition from that. Let's go back to what we were talking about in that video. We were talking a lot about CBDC. Who on here can tell me what CBDC is? Can anyone right now just in the chat tell me what does CBDC mean? And it has nothing to do with THC. Central bank digital currency. That's right. I don't know whether or not you've seen it or maybe you caught it in that video, but starting in July, the Fed is going to roll out what they're calling Fed Now. It's a payment method. It's kind of almost like I don't want to call it a Venmo or one of the other cash apps that you're so used to using, but it's going to be controlled by the Fed. And they're going to roll that out. And it's going to mean instant clearing of all transactions. That's the whole idea behind digital currency. But you see, you're all familiar with digital currency. You've been doing it for years and years and years. You pull out your credit card, you pay for your dinner. You use Venmo to send money to people. You use PayPal, you use Zelle. All of those are basically a form of digital currency and transacting business. But the difference is all of those still rely on the old clearing system, which is where a bank technically has to clear the funds. So when you send money by Zelle, essentially, there's kind of an IOU until it's cleared. And sometimes that can take a couple hours. Sometimes it can take a couple days. Any of you that are using your specially designed and engineered whole life policies for the infinite banking concept, you always know, we always say when you want to take a loan, it's an ACH, and it's going to take up to 36 hours. Why do you think that is? Well, it's because it's got to clear. It has nothing to do with the insurance company. It really has more to do with the bank. The bank's got to clear the transaction and make sure that the money is ready to go inside of the policy before you can take a loan out. So when we talk about digital transactions, all the days of going to the bank and depositing money and having to wait, and how many of you have ever dealt with that? You go to the bank, you make a deposit, and then you sit there and you're like waiting. You got bills to pay, you got money to take out, but you got to wait for that check to clear. Or I love when you do it from the same bank, right? You write one check out of your business account, you put it into the same bank, and then they still hold it for a day. Isn't that a racket? It's like, wait a second, all the money should be in that vault. It's the same bank. Like, why isn't this clearing? But yet they still make you wait a day. And I bet you some of you have even bounced checks because of that exact thing. Well, don't worry. The government and the Fed got you covered this time, folks, because good old CBDC and good old Fed Now, not going to have to worry about that no more. Nope. Everything will clear instantly, almost light speed. So I guess that would be a pro if there's any pro to what's going on. But what we give up, and you know, it's funny, if you watch that video that I posted on YouTube and you read the comments, there's some people that actually like want this to happen. And there's other people that think that the answer to everything is cut military spending. And there's other people that literally just deserve to get on a boat or a plane and go to China and live there forever to see that the grass is not greener. But getting back to reality, when you talk about CBDC and the Fed now, a lot of people send us emails across all of our money mentors with what we do. How is this going to affect our banking policies? How is this going to affect my whole life? How is this going to affect what I do with the infinite banking concept? Got some good news for you. It's not going to affect it at all. Do you know why? Well, it all comes down to where you live. So right now in the chat, if everybody in the chat could just tell me where you're coming in from. Are you coming in? I know Mark's coming in from Hawaii, but Texas, we got California, New York, Toronto, Ontario. Okay, we got some Canadians on here, eh? So we got people coming from all over the country, but I do want all of you, except for the Canadians, to realize one thing. You live in the United States of America. No pun intended to the Canadians, but the last time I checked, the United States of America is the greatest country on earth, the land of the free and the land of opportunity. True or true? Well, that still holds true today. There's been a lot of folks, some of you know people, there's been a lot of people in your past that have given everything, their lives, to protect that freedom. And I'm sure in the future, we're going to have to do the same thing again and again, if we're ever going to remain free. But because we live in this free country called the United States of America, unfortunately or fortunately, depending on how you look at it, glass is either half empty or half full. It's all perspective. This right here, the dollar, this is how we transact for goods and services. This is the only means of exchange that we are allowed to use in this country. It is what it is. So if the dollar is going up in value, yay. If the dollar is losing value, oh, boo-hoo. But this is it. So whether it's paper fiat currency like what I'm holding, or whether it's a digital currency, this is all we have. So a lot of people want to complain about it. They want to get, upset that we're going to go to this digital currency, which folks, we are. I mean, they've been testing it. Out of all the countries, there are 114 countries in the world are adopting some form of digital currency. We did the math. But I got some good news. For us here in the United States, our dollars, for all the transactions used worldwide, our dollar accounts for 60% of them. Well, it is the reserve currency, the petrodollar. It is what oil is currently valued in. Obviously, the Saudis and Russia and China and India and the BRICS are all kind of coming up with their own little things, but there still is no currency that holds the stability and the financial strength of the US dollar, digital or paper, doesn't matter. So I want you right now, right here, to understand that you can complain about it. You can feel negative about the digital dollar. You can feel whatever you want, but it doesn't matter because living in this country, getting the freedom that we have, you're going to adopt whatever they decide is our means of exchange. So that's the good and the bad of it. But the other good and bad about it is it doesn't affect anything with what we do with the infinite banking concept. Everything we talk about with the infinite banking concept involves changing just one thing. And I ask people all the time, can you change one thing? How about it right now? Can all of you agree that it wouldn't be hard for you to change one thing? Put I in the chat. All you got to do is change one thing. Not hard, right? The second thing I've added is once you change one thing, and that one thing is where the dollars that you make go first, whether it's US or Canada. I mean, I really kind of look at them one and the same. I'm from Buffalo, New York, so I'm almost Canadian. When you talk about, what's your nationality? Well, I'm a little bit of German. I'm a little bit of this. I'm a little bit of that. I'm like half Canadian just by sheer demographics. Like my neighbors are Canadian. That's right. They all live right there. I can be over the border in 15 minutes flat. Yes, get held up at the border, but no big deal. So your dollars are what you work for. They're what you trade time for. And they're what get things done in your life, good, bad, or indifferent. All I'm asking you to do is to say, yes, I could agree that I could change where that money goes first. And instead of putting that money in a traditional bank, God forbid any of you out in California had your money in Silicon Valley Bank or in New York, maybe Signature Bank, or wait a second, UBS and Credit Suisse. And what were the other ones? There's too many to even remember. And that journey is just beginning. Says Warren Buffett, he says, the bank failures we've seen are just the start of it. That's Warren Buffett saying that in the news this morning on WTF. So now we change where our money goes because we no longer trust and we no longer want to give up control to their bank. So we want to create our own banking system. And to do that, you better take back control. So what do? We put it in the same place the wealthiest families in history have put their wealth. Not only the wealthiest families, but also the major corporations in this country and also probably abroad. And not only that, banks. That's right. The banks, which we're trying to get away from, put their money in the same place where I'm going to tell you to put your money. And what is that? This is the hard part. It is a specially designed and engineered whole life insurance policy from a mutually owned company. But you already all know that. So I'm not going to beat up the whys and that. Let's just start with a couple. Number one, it's guaranteed interest. Okay. The insurance companies we work with pay anywhere between 2 and 3.25%, guaranteed contractually for the rest of your life. Now, some of you are thinking about that and you're like, wait, Chris, that's it's really not that great of a rate. See, my bank is paying me 3% right now, but it is not guaranteed, I would tell you. Your bank might be paying you 3% right now because we're in a rising interest rate cycle. But if you can just kind of remember just a few years back, when COVID and the pandemic kicked in and the Fed dropped interest rates to zero, what happened to your bank account that was earning some form of interest? That's right. It went to zero. So your interest rate you get at a bank is not guaranteed in any way, shape, or form. But the interest rate you're getting in an insurance policy is contractually guaranteed, not just this year. Nope, wait, not just next year, for your whole life. On top of that, I mentioned mutually owned insurance companies. Well, because they're mutually owned, the policy owners, you, when you decide to become your own bank, the policy owners get a dividend every single year. And I'll take one from Dave Ramsey. If any of you follow Dave Ramsey, who hates whole life, he goes on in a video where he said IBC is a scam. Now, if you can watch his video, but make sure you watch my video where I do a rebuttal of all the things he's saying. He clearly has no idea what IBC is. But in that video, he says, oh, those insurance companies and all those guys saying that, you know, they get a dividend every year. Hell, that dividend is nothing more than a return of unused premiums. I'm like, good job, Dave. Good job, man. You just cracked the code, dude. It is. It's the insurance companies are just returning unused premiums that they didn't have to use because people didn't die. It's a good thing. And he's like, well, it's just unused premiums. It's not really a dividend. It's not really them giving you the profit. Actually, it's identical, Dave. It's identical because giving unused premiums back to the policyholders or giving you part of the profits of a company in the form of a dividend with a stock company like Apple, they're identical. But there is one big difference. You see, when you get a dividend from Apple or you get a dividend from Microsoft, or you get a dividend from, is GM still paying dividends? Probably not, because they're owned by the government 61%. But anyway, we'll leave that out of the equation. Your stock dividends, you got to pay tax on those every year, don't you? If they're not in a retirement account, you pay tax on them. But you see, when it's a return of unused premium, it's all in the language in the IRS code, it's tax-free. So let me ask you, do any of you really care that the insurance company says that it's a return of unused premiums when it's tax-free? Or would you prefer them to call it profits and then you can pay tax on it? Tax-free or taxed? You get to pick. So Dave Ramsey calls that bad. I say that's brilliant. So you get guaranteed interest, you get a dividend, and the best part is since we changed where the money goes first, now that's there in a protected private place. It also provides a legacy. So if any of you have families or people you care about, when you graduate and go to a better place, guess what? Your family's going to get a big tax-free death benefit. When we talk about life insurance, the bad thing is oh, you got to wait to die to tap into that death benefit. Wrong. Matter of fact, when I put the money in the specially designed and engineered whole life, I have the ability to go into that policy and I have the ability to take a loan from the policy and I get to use that money for anything I want. I could buy a car. I can invest in any of your real estate deals by lending money. I can lend money and put money in hedge funds. I can buy equipment, which a new video is coming to my YouTube about flipping equipment. I can do anything. But here's the cool part. When I put the money in the policy and I take the loan, I'm not actually taking my money out. Yeah, that's right. So if I put 10 grand into a policy and I take 8 grand out, there's still 10 grand in my policy. Some of you are like, okay, the math doesn't make sense there, Chris. You put 10 in, but you took 8 out. You should only have 2 left. That's how my bank account would work, right? That's why we don't use bank accounts. That's why we use specially designed whole life. Because you see, the insurance company in the contract allows us to use our death benefit while we're living. Novel idea. Dave Ramsey didn't really know about that one either. Yeah, we can borrow against our death benefit. And then all the insurance company does is if we got 10 grand in there, they'll just use that to collateralize that $8,000 loan. The cool part is, and I'm going to show you the math on this today, the 10,000 that's in your policy is still earning guaranteed interest and dividends. They're charging you interest on the loan that you took from your death benefit. As of right now, the interest on the loan is less than the interest and dividends that you're earning, so you're making a positive spread. But I'm also going to show you something that's going to blow your mind, is it wouldn't even matter if the interest they were charging you on the loan was more than what they're paying you. Now that should confuse you. But in the infinite banking concept, we'll get back to that spread. It's all about what I just said. It's all about a process. We take the loan out and we make that money go to work for us. Let me give you an example. Very recently, and the video is coming soon, I flipped a forklift. Flipping houses, that's freaking old news. And it's a lot of work and the contractors are a pain in the butt. So I wanted to find a better way to make money without all the hassle. So I found a company that buys used forklifts and renovates them. And I'm like, hey, what's your biggest hurdle? Well, we could buy more of these things, but we don't have the capital. I said, okay, well, what if I had the capital? Can I buy the forklift? You guys just keep it at your facility. You guys do all the work. And at the end, we work out a deal where we just split the profits? Sure. So we worked a deal out like that. So I took money from my policy. I bought a $26,000 forklift. It was all beat up. It looked like it had gone through a war or gone through Jurassic Park. It was all scratched up. Seat looked like it got bit by Tyrannosaurus Rex. Anyway, so I owned this machine. But they've got a whole shop, 40,000 square feet, where they go through and they renovate the thing. They flip it. They paint it. They put new seats on. They put new tires. I remember I walked in, me and Jordan here, who's filming right now. What's up, Jordan? We looked at the forklift that I was buying. And I literally was like, wow, this thing's rough. I was kind of hoping to get something that looked a little better. But then they took us over and they showed us other forklifts that I swear to you, I thought were brand spanking new. I'm like, these must be brand new ones. I didn't know you guys really did much with brand new. And he says, no, these are just refurbished. I said, that's a refurbished forklift? And it looked brand spanking new. Okay, so about a little over 2 weeks later, I got a phone call and I went back to the shop and they showed me my forklift. But it didn't look like the old one. It looked like a brand new forklift. Now remember, I took the loan from my policy to buy this forklift. So I was making no interest on this. After the forklift was renovated and I went there and I looked at it, they then sell it to one of their buyers. They got salespeople. They got a whole list of people that buy forklifts, companies across the country. So I get another call and they told me that they sold the forklift. I think they sold it for a little over, 40 grand. We had like 30 into it. So the profit was about 10 grand. And the split was 60-40. So I got a check for a little over $4,000 plus my $26,000 back. So literally, I made over $4,000 in a smidgen over 2 months. Maybe it was a little less than 2 months. I don't remember. Just do the math. So then I took the money that I took out, the 26 grand, I put it back in the policy. You see, here's the difference. It was a circle, folks. All I did, this is where we're talking about the infinite banking concept. Remember, I changed where my money went first. I put it into that stupid whole life. I then took a loan from the whole life, which they do charge me interest. Now, I don't remember what policy I took it out from, but let's just use 5.5% is what they charged me in loan interest on that. And then I bought a forklift. Okay. And I'm going to try to just draw a forklift here. Not too shabby. Yep. There's my forklift. Kind of looked like that, right, Jordan? Had a little smokestack there. All right. So I bought this for 26K. They renovated it. And then I got a check for 30 grand, a little over 30 grand. Okay. Which included a $4,000 profit. So what I instantly did is I took $26,000, I put it back into the policy, $26,000. Why didn't I put all 30? Because I couldn't. My policy wouldn't hold all 30. So what I had to do is I had to stop off here and park $4,000 in change in a traditional bank account. This we call the segregated bank. So now my policy is made whole. I got 26 grand again. So I could just repeat this process. I could just say, hey guys, you got another forklift? Yep, we got one for 14,000. Wonderful. They do that and I make 2. And then I just add 2 here. But the cool part about as this whole wheel keeps going, right here in the beginning, which we'll go through the numbers, the insurance company was paying me interest and dividends. And I think that was a policy that made 6. I'm doing gross numbers. I want to be clear about that. This does not factor out cost of insurance, policy service fee. So I'm just doing gross. But right there, you could see that's about 0.5%, okay, or 50. Okay, let's just do it this way because this is how my mind works. 50 bips, which is 50 basis points, 0.5%. This is a spread. but I also made a spread over here. Okay, so I made money twice. In a traditional bank, I could have bought the forklift. I could have taken the money from a bank account, bought the forklift, put the profit back in the bank, but I wouldn't have made the spread. And the other thing that gets better is time, called compound interest, makes it so that I continually keep making more and more and more money in a spread. You see, it might start at 50 bips, but eventually maybe it's 2%. And then it goes up. And next year, maybe it's 3%. You see, every single year, because my money never comes out of the account, I never, ever stop the flow of compound interest. Therefore, it becomes uninterrupted compound interest, something that most people have no idea how to achieve. How do I earn compound interest, but still have the access to use the money and not interrupted? I don't know how to do that. I just showed you how to do it. You just change where the money goes first, and then you add a second step, which is called the infinite banking concept, which is the process I just showed you. This right here is the process. Who cares about this? You could do the infinite banking concept without the whole life. I wouldn't suggest it because then you don't make this spread. But you could do the infinite banking concept and subtract the whole life. The infinite banking concept is nothing more than a process.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Now, here's something I want to walk through here. Okay, and for some of you, this is going to be something you've seen, but you can't see this enough times. This is where the math comes in. And what we did today for this training is I wanted to show you why you have been doing the math wrong all along. I'm going to demonstrate how you, for most of your life, have done math wrong. It's not so much that you're doing math wrong. It's you're missing a very important piece. And that important piece was outlined by Albert Einstein very clearly. And you can Google it. You can find everything Albert talked about when it came to compound interest. You see, Albert Einstein, when he referred to compound interest, he said it was the eighth wonder of the world. And he went on to say, those that understand it, earn it. Those that don't, pay it. So you got to ask yourself, do you understand compound interest or do you not? Because if you don't, you're paying it. Most people pay compound interest. One big thing that we get a lot when it comes to the specially designed whole lives and when it comes to the infinite banking concept comes down to a lot of people, they focus everything on the policy and they get so hung up on the interest rate and the dividends that the policy pays that that's all they see, that's all they want to hear about, and anything outside of that is just, it's noise to them. So I'm going to use a policy that pays 5.2% with dividends. So that's interest and dividend. That's the only number I want in your head, 5.2, okay? Let's just say that interest rates keep going up, the Fed keeps raising them, and this insurance company, now, full disclaimer, what the number I'm going to give you now, the loan interest rate, this is not the loan interest rate with any of the insurance companies we use. I'm going to over-exaggerate. I'm going to over-exaggerate because I want to prove a point. Let's just say that the loan interest rate was 7%. So for you to borrow your death benefit from your policy, you would have to pay 7% interest when you're only making 5.2. Pause. In the chat, how many of you would be like, no problem, I like that? Or how many of you would never do this if that was what you initially were showed, which it is not. Again, full disclaimer, there's not a company that charges 7% interest right now, but I just want to know. So Morgan said, yes, do it. James Davidson said over and over again, they've been around the campfire, but let's get some of the newcomers. How many of you are brand new here? I want you to just think about that. You're making 5.2 uninterrupted compound interest, and it costs you 7% to use your cash value. Terry says, no problem. Some of you got to be thinking differently here, right? We can't just have all the people that have been around the campfire saying, yep, I would do it, of course. Enrique said, oh, yes, brand new. The math doesn't make sense to me. I love it. Jose said, math doesn't make sense to me. So are you getting money at 1.8? Not sure I would, not from a bank. Depends on how long you keep the money out. So we got a lot of answers, but you did hear some people say no. And David said, is it 7.2 annual or compounded? It's compounded. It doesn't, the 7% interest on the loan is simple interest. So remember, you're earning 5.2 compound interest, paying 7% simple interest. That's a key. That's very important. All right. So is anyone on here buying a car this year? Can anyone volunteer? Actually, Morgan, can I just pick on you? Can you buy a car this year? Morgan is going to buy a $25,000 car. Okay, as represented on the screen that you're looking at right now. So that's going to be Morgan's car. He goes, he looks at it, he's all excited about it. But Morgan has been saving up in a really good bank. So he wanted to pay cash for the car, and he's been saving up for this car. Now, you all know there's 4 ways to buy a car. Number 1, you can pay cash like Morgan has been trying to do. He's been saving up, and he's actually finally saved up $25,000 in his really good bank, because he wanted to pay cash for the car. So that's the first way you can buy a car. The second way, you can always finance a car through a traditional bank or finance company, right? In doing that, what they do is they'll give you a loan. That loan will include you making monthly payments back to the finance company or bank, and those monthly payments include principal and interest. We all understand that to be true. The third way you can buy a car is you can lease it. Same idea as financing it, except for you got to give the car back at the end. So that's a pretty bad deal. You make monthly principal and interest payments to the bank or the finance company. And then 3 or 5 years later, when your lease is done, you hand the car back in and you're just like, all right, you got nothing. Oh, but you get a tax deduction. Don't get me started. I'll bring Jimmy in on that one. And the fourth way you can buy a car is you can steal it. But Morgan is not going to steal the car. Morgan wanted to pay cash for the car. So here it is right on the screen. He found himself a $25,000 car. It's a beautiful car. Okay, it's a Ford Focus, all decked out for 25 grand. And he's got 25 grand in a really good bank paying him 4% interest. Now I'm going to play the banker, because why not? He found a good bank, so why shouldn't Mr. Naugle be the banker? So Morgan comes into the bank and says, hey, Mr. Naugle, how you doing today? I'm like, hey, Morgan, what's happening, bud? What can I do to help you today? And Morgan says to me, hey, listen, I know I've got that 25 grand saved in this bank, and I know you guys are a great bank. You've been paying me 4% interest on my money. I'm very thankful for that. But I got to take that 25 grand out because I want to buy a car and I want to pay cash. And me being the banker, I say, okay, Morgan, well, why would you want to do that? And Morgan says, because I don't want monthly payments. And I say, fair enough. But then I propose a solution to Morgan. I say, Morgan, listen, you've been our customer for a long time. I'm going to make a recommendation to you. How about our bank makes you a loan for that car? And we're going to charge you 6% on that loan, simple interest, over 60 months. You can do it for any term, but this is just my proposal to you, Morgan. We'll give you a loan at 6% for 60 months. And that way, Morgan, you can keep your $25,000 in this really good bank, which means that $25,000 will be able to earn compound interest at a rate of 4%. And all we'll do as the bank to secure and protect ourselves is we'll just use your bank balance as collateral. Matter of fact, we don't even need to put a lien on the car. We're just going to use your bank balance, that 25 grand, as collateral. Right off the bat. Is that a good deal for Morgan? Morgan's going to pay us, the really good bank, 6% interest on that $25,000 car loan. And Morgan's going to earn 4% on that bank balance in that really good bank. Now, when I do this presentation across the country, and when anyone on our team does this, if we ask the audience and they've never seen this, most of our audience would say, nope, Morgan, that's not a good deal, man. You're paying 6 and you're only earning 4. Morgan, you're losing 2%, man. What's wrong with that banker Naugle, man? He's steering you off a cliff. But then I go and I throw a left hook to Morgan. I say, Morgan, hey, I promise you, I guarantee you, Morgan, that our bank will pay you more interest on that $25,000 earning 4% than you will ever pay us on that 6% loan for 60 months. Is Mr. Naugle, the banker, lying to you? Is it even possible to earn more when you're getting 4% interest and you're paying 6%? That's the magic question. And most people from the surface would say no. You see, I led into this with this question I asked. Is it possible to make more earning 5.2 in the policy when you're paying 7? Now, some of you said no. So all of you that said no would also agree here that this is a bad deal for Morgan. So let's run the math, Morgan, because I want to prove this to you, because you know what? Our bank's name and my name, Mr. Naugle, the banker, are on the line, because I just guaranteed you that we'd pay you more interest on that 25,000 earning 4% than you'll ever pay us on that 6% car loan. So here's the math. The monthly payment would be $483.32. That's what the calculation on the simple interest car loan would be, okay? And if Morgan makes all of those 60 monthly payments to the bank, Morgan would have paid $28,999 for that automobile. $25,000 for the purchase of it, the rest is interest. Fair enough? Now the magic question here is, how much did Morgan's bank account grow to? Remember, Morgan's bank account's only earning 4% and he's been paying 6% on the car loan. So of course the bank account's got to be less than what Morgan paid in for that car, right? If we just do a compound interest calculator over the exact same time frame, and folks, this works whether it's 60 months, 36 months, 120 months, doesn't matter. The math is always the same, okay? But over 60 months, which what we showed here, Morgan's bank account balance earning 4% would have grown to $30,525. Now, unless we do math a little differently out here in Buffalo than you do wherever you're at, that means Morgan made $1,526 more on his bank account balance than he paid on that 6% car loan. So it is absolutely possible to earn more earning 4 when you're paying 6 if you understand the difference between simple interest and compound interest. And secondarily, if you understand the difference of one compounding, Albert Einstein's eighth wonder of the world, and one declining, because really the math here is quite simple. You see, Morgan every month was making a monthly payment of $483.32 to that really good bank. And every payment he made to that bank reduced the balance. In a simple interest loan, every payment he makes reduces the principal, which means the next interest that's charged is less, and on and on. So every payment he made on that loan reduced the principal and also reduced the amount of interest he's paying. So what I wanted to do is show you this as the beginning part of what we're going into, because now I want to show you something that's really going to blow your mind. Remember I told you about the policy earning 5.2, and I hypothetically said, hey, what if we found an insurance company that charges 7? That would be a bad deal. And then, you know, here I said, we're going to take that money out and we're going to buy a car. Because many of you probably already know this, but that example I just did for Morgan, that wasn't a bank. I wasn't a really good banker from a really good bank. I was Chris Naugle, teaching you a concept called the infinite banking concept. Not using a bank, although I called it a bank, but now let's just put your name on the bank. So instead of that really good bank just being a really good bank, and in your mind, you're thinking, okay, well, is it Bank of America? Is that Ally Bank? Who's paying 4% out there? That's an insurance company. It's a giant mutually owned insurance company. That example I just used, the one that I just showed you, and if any of you had forgotten about it, I'll just quickly flash it up. This one right here, this right here was not a bank. This right here was your bank. That was a giant mutually owned insurance company, and this is your specially designed whole life that pays you a guaranteed interest rate, and I only use 4%. So I just wanted to be clear that when we do this example to the public, we're just trying to show you that perception is not always as it seems. So here's what I want to do is another mathematical equation, because I often say, all right, that's 4 and 6. But what if it wasn't 4 and 6? What if it was 5.2 and 7? Would the math still work? So what I did is I did a mathematical calculation, and I'll show you exactly how you can all do this yourself. But I'm just going to put it on the board. Here's a loan amortization. Now, we're going to up the ante and we're going to buy a $50,000 vehicle. Why? Well, I don't know, nicer car. So you're going to buy a $50,000 car. You're going to pay 7% simple interest on that car, which means your monthly payment would be $990.06. Everybody's got it? And if I do the loan amortization, and I can show you how to do this, I use a company called bankrate.com. Stephen, you ever do it on bankrate.com?
Yeah, definitely. It's a great resource.
It's easy, right? So here's our car loan, 50 grand. We're going to do it for 5 years, for 60 months. And I put a rate of 7%. And here's the cool thing. I can put any rate I want. We're going to play around with the rate today, but I did 7%. And then you just click calculate. It'll show you your monthly payment and it'll show you the total interest paid, $9,403.60. But what else is cool is I can come down and I can click show amortization schedule. Remember I was saying every payment you make in a simple interest loan, and I want to keep prefacing that, In a simple interest loan, every payment you make, some goes to principal, some goes to interest. But you see, every payment we make, we reduce the balance. See here, 49 goes to 48, goes to 47. And every single time we do that, notice how our interest is going down, down, and down every month. So remember in that example where I said you made more at 4 than you did paying 6. Now what I'm going to do is I'm going to show you that exact same thing, but I'm going to flip this script and I'm going to show you here's your compound interest. Okay. So all I do is I go into the same thing, bankrate.com, 50,000, same amount of time, 5 years, earning 5.2% compound interest. And here, how do you contribute? We're not putting any new money, and it's going to compound daily. Now you can compound daily, you can compound monthly, quarterly, or annually, but the insurance companies pay daily interest. They calculate it every single day. And I do that. And it would basically show me over that time frame, 50,000 would have earned $14,845.30, which means my total savings would have went from 50 to 64,845. So all I'm trying to do is to show you that the math right here behind me pencils. If this is your $50,000 loan at 7%, hypothetically assuming that the insurance company charges you 7%, which none of them do, I'm way overshooting this. And then I'm just going to an insurance company, which we do have one of our best insurance companies, and that's about what they pay, 5.2. At 5.2, this is how much you would have made. So you would have made 14,845, and you would have paid interest of 9,403. But you see, the cool thing about this entire situation here is if you did this $990.06 that you're paying back to your policy as a loan repayment. Remember, when you're the bank, you're also used to making car payments. Ally Bank, Bank of America, GM Finance, whatever you pay your payments to. I don't care who it is. You're used to that payment being gone every single month. You make the payment. Yes, the car's in the driveway, but the payment's gone. You can't just go back and take it. Here's an epiphany that many of you have already had, and some of you will have. The epiphany comes when you make your car payment, $990 on a $50,000 loan at 7%. When you make your car payment to your bank, and just as a refresher, your bank is a specially designed and engineered whole life. But what I'm talking about is I'm talking about paying the loan back. You took a loan for 50 grand. Remember how Morgan saved 25 grand and then he wanted to take the 25 grand out? Here, I'm just assuming that you saved 50 grand and you took the 50 grand out and you bought the car. But the 50 grand you took out, I'm assuming that the insurance company charges you 7% simple interest. The cool part is every time you pay $990 a month, let me come back to this. This is really cool. You have $990.06 back in your policy. That's right. You have $990 back in your policy. And I'm just going to show this to you. So some of you are like, no, you got to pay the insurance company. Wrong. The insurance company sends you a bill one time during your policy anniversary. So one time a year, the insurance company sends you a statement showing you all your numbers and shows you how much interest you owe on that loan. But every year we're paying the loan down. So every year we're reducing the amount of interest we pay the insurance company. And let me just show you this. Remember here's your amortization schedule. So all of this money in interest that you're making in that car payment, all of that interest is yours to keep, yours to use, and yours to do anything you want. But for the course of a year, for the course of an entire year, all $990 of that monthly payment is yours. You didn't pay it to GM Finance. You didn't pay it to Mercedes Credit. You didn't pay it to whatever your car company is that you make a car payment to. You paid it to your bank. And therefore, you controlled every bit of that $990. Now, at the end of the year, when the insurance company sends you your statement and it shows the interest due, you will write a check for the interest due. And no one should ever complain about that because you know what? The insurance company already paid you the interest and dividends. Because remember, your money never, ever, ever left your account and your money always earned compound interest. So I wanted to do this because it doesn't matter how we run the math. As of right now, a lot of the insurance companies, let's just say they're 5.75%. And I get this all the time. People complaining about this all the time. So if I change this to 5.75, our monthly payment drops to $960.86. So I'm just changing it up, or 84 cents up here on the board. In this scenario, if we calculate that at 5.75 and we go down and we were to look at the amortization schedule, we only pay $7,650 in interest. But if I flip over to the compound interest calculator, let's just net this out and let's just do the math. What if you only made 4%? Would you make more? So let's say at 4%, you'd have $61,000. Over here, how much did you pay total for the car? Calculate that. Actually, I got to do the math here real quick because it doesn't tell me what we actually end up paying for that car. Tricky, tricky. All right, so we just simply do this. We take 960.84 times 60 months. You paid $57,650 for the car, but you made 61. Okay, so what if we only make 3%? Remember, I'm keeping the loan interest rate at what it is today, but let's just say we make 3%. You paid $57,650 for the car at 3%. You still made more at 58. How about 2%? I think we're going to go backwards here. But there is an insurance company that we have even on the internal rate of return, which we never use because we use cash on cash, that only pays you 2%. So at 2%, you paid $57,650 for the car with interest at 5.75%. And at 2% interest compounded, you made 55. So what's the magic? Is it 2.5? That's our break even? Maybe 2.75. What I'm trying to outline here, folks, there we go. You're making a little more at 2.75%. You can pay 5.75% interest right here, 5.75% interest, and only earn 2.75% compound uninterrupted interest, and you make more. If that doesn't open your eyes, then nothing I ever say will impress you. Nothing I ever say will excite you, because right there, that I remember when I saw it was an eye opener. Stephen, what questions do we have about this before we move on to the next topic?
Well, we've had a bunch of questions rolling in. I don't know if we want to kind of just start hitting them as we go.
Well, is there any that were really, really appropriate for what we just showed here?
What if I were to buy the car through a corporation and write off most of the payment? How would this compare?
What would be any different? So you buy a car, okay? And let's just say the policy is owned by your corporation. So if you're going to buy a car with your corporation, okay, now we're not talking about financing, and we're talking about paying cash. If you're going to buy a car for your corporation because you want to write it off, it'd be no different if you bought the car personally and you just used it for work and documented your miles or documented your gas receipts or whatever. And I did a whole video on this too. I actually bought a vehicle, a G-Wagon. I then leased that G-Wagon to my entity, and my entity made monthly payments back to me, and I wrote those off. But the income that came back to me was taxable, so it was really a wash. But I ended up getting all the money back for that G-Wagon, and my company paid for it. So it depends on how you swing it. You could do it any which way. The policy could be owned by the company. The policy could be owned by you personally. Either way, it still works the same. It's just mathematics. If you're trying to get the tax deduction, well, make sure you're using the vehicle for your business use. Make sure you consult with your CPA for how that would work. Maybe it would make sense having your CPA watch my video on how I lease that vehicle to my company. And maybe your CPA would say that's full. Me and Devin both did a video. Mine went 10 million views on Instagram. And out of all of the comments, thousands and thousands and thousands of comments, I'd say about 90% of all of those thousands and thousands of comments were negative. People saying, oh, this is illegal, blah, blah, blah. Do you know who came up with the idea? My CPA. Where is that illegal? It's right in the tax code. You can do it. If you lease a vehicle from GM, you can write the payment off as long as the vehicle is used for business. So if you lease the vehicle from yourself, what's the difference? There isn't really. Consult with your CPA, and that would be the first step, but it will work. What else do we got?
Just if somebody already bought a car, a couple of questions coming in like this. If they already bought a car, can they open a policy now and then just buy the loan out essentially?
100%. So that's actually good. Remember that. So whoever that person is, I'm going to show you an exact example of doing just that, if that's okay.
Just to expand on that a little bit. So Kenny said he just bought a 2015 Vet for 46,000. You know, can I open a policy and buy out the bank? And so one of the things we can do with these too is
can we just do the case study right now on that?
Yeah. Yeah.
Like, because that's perfect. You're like, what's his name? Kenny?
Kenny. Yeah. It's a 2015 Corvette for 46,000.
Cool. I mean, who doesn't like a Corvette, right?
I know, right?
I don't know how old Kenny is, but it just so happens that I'm getting prepared to do a brand new training. One of my best YouTube videos ever was how to design an IBC policy. So that video is old, and some of the policy designs in there are pre-7702 changes. So I just wanted to do a new one. We're doing a how to design an IBC policy 2.0. And here are the designs that I did for that. And it just so happens, Kenny, that I did a design that works perfectly for your vet. So let's just draw the vet. Okay. Now, Kenny, I know your vet's going to look way cooler than the one I'm going to draw here. Actually, we got to make it lower. Remember, on a vet, you're sitting right on the ground. There we go. Okay. We got that big long hood on it. Is it a convertible or is it a hard top? Doesn't matter. We're going to make you a convertible here. There we go.
Kenny's 60, just so you know.
Whether or not this looks like your Corvette, Kenny, it doesn't really matter. There we go. We got ourselves a Corvette. Okay. So this is Kenny's Corvette, and he paid $46,000 for that vehicle. Now, when he bought this, it sounds like he took out a loan. So real quick, Kenny, just stay with us here and stay in the chat. What is your interest rate on the loan and what is your monthly payment on that? Those are two numbers that I'm going to need to finish this up. Before we get into that, as we're doing that, what we are going to do, remember, is we're going to change where our money goes first. Now, this isn't appropriate for everybody. Some of you, like, you buy a car and you buy it because you didn't have the money to pay cash for it. But I guarantee you there's a lot of you on here that bought a car, you financed the car because you were like, I don't want to take the money out of my bank account. I just don't want to. I want to keep that money so that if I get an opportunity, I want to use it, right? There's a lot of people like that. So in this example, I literally am going to show somebody that has $50,000. So it would require, this example would require Kenny to have $50,000 bucks. So he's going to change one thing, and that is where the money goes first. He's going to put the money into a specially designed and engineered whole life that we designed for him. Okay. And with this company, I'm not sure what the interest rate and dividends are. I know they just changed, but we'll just call it 5.6%. I think I'm maybe 5 basis points lower. So did he get back to us with the payment?
Yeah, so it's a convertible. The interest is 6.69 and the monthly payment is $870.
Everybody followed that, right? So we bought a convertible vet. Pretty cool that I actually got it right. What color is the vet? Is it red by any chance?
No, 6.92 actually is the rate. 6.92.
6.92, even worse, 6.92% loan, okay, on 46. And I would assume this is a 5-year loan, kind of like what we've been talking about based on the numbers. All right, so we got this Corvette, but he's got 50 grand. And he's like, hey, this looks really cool. Instead of giving away all this money to the bank, I want to get all the money back from my Corvette, right? Who doesn't want to get all the money back for every single car that they buy, drive, and own? Kenny's like, I do. Okay. Well, Kenny's fortunate because Kenny just so happens to have 50 grand sitting in his bank. So he does what we tell him, and he puts that 50 grand into this specially designed whole life. Now, immediately within the first 30 days, what he's going to do is he's going to go in and here's the actual math. Kenny, by the math, at the end of the first year has exactly $46,017 he can take out of this policy. So if he only put 50 in, he might be a bit short in the first couple months, but we'll just play it out, right? This is 46,000 he's going to take out as a loan. Now, this company, I think, charges, I don't know what they charge. We're just going to say 5.5%. All the insurance companies just raise the interest rate, but I already proved to you, it really doesn't matter. It's not a numbers game. It's a compound interest versus a simple interest. And in this equation, it doesn't make any difference because Kenny's going to pay all the money back to his bank. See, Kenny's already used to making an $870 a month payment. What Kenny doesn't like is every single month he makes this $870 monthly payment, he pays it to somebody else's bank. So he takes this loan out against his death benefit. Remember, because he does that, let's just say his death benefit started at $1 million. He took 46,000. The insurance company is going to do a calculation. They're going to subtract from his $1 million death benefit. They're going to subtract 46,000 because that's what he's doing. He's borrowing from his death benefit, and the insurance company gives him this loan. Okay, so now he's got the loan. He pays off their bank. But what Kenny's not going to do is just call it quits there. He's not going to steal from his bank because this is his bank. So let me just write BYOB. Kenny decided to be his own bank. Part of when he decided to be his own bank, he decided he was never going to steal from his bank. He decided also he was going to treat his money in his bank the same way he treats the money that goes to their bank. So all he does is, instead of making this $870 a month payment to somebody else's bank, he just changes the name on the check. And we're just going to write Kenny's bank. So he does a check every single month. He sets up a bill pay. He's got this little check here, $870, Kenny's bank. This is the check. And we'll just call it a bill pay. So he does that. So every single month, $870 a month goes back to his policy. This is what we call recycle and recapture. No new dollars have changed hands here. It's all the same money Kenny's already spending. It's the same money Kenny already had. Kenny already had 50 grand in savings. We just changed where the 50 grand went. Kenny was already making $870 a month payments to somebody else. Okay. But down here, the difference is now the $870 a month payments are going to go back into his policy as a loan repayment, because that's what it's called. It's called a loan repayment. So which means most time when you think of a loan repayment, you think of the money being gone. But in this case, he is the bank. $870 a month will show up in his cash value. That's it. And round we go. Now, so let's see, let's just do his. It was a $46,000. Let's see if I can get the numbers to work. Loan, 60 months, 6.92%. I'm a little off. So maybe it was 6 years that he did it. Let's just check it out. It doesn't matter the amount of years. I'm just trying to get the numbers to work, because what I was going to show you is how much money he's going to, it's super close. I'm off by 20 bucks a month, close enough. But if it was this, Kenny on his loan would have then paid himself back, and this is crazy, $9,289.46. That's the interest he would have just given away before, that now he basically puts back in his policy. But not only that, you see, over 5 years, or this is actually almost a 6-year loan. I just want to kind of give you the math. So every year, Kenny continues to save money in his policy. So we just did this. I just showed you how the infinite banking concept works, but we didn't really talk about the spread. So let's go into some of the math for Kenny's Corvette. So the first year he put in 50 grand. And like I said, his cash value, this is his premium deposit, and this is his cash value. So his cash value end of year one, when he gets his dividend, is $46,017. And I don't know, let's just, the death benefit would be 887 in this, but I'm 46. So this is based on me. He just did 50 grand the first year, which was 10,000 plus a $40,000 dump in. So every year he's going to put $10,000 in. That's what he's going to save. Everybody's got that. So now let's just do the math over here. Now, the first year, that's what he had. Now, each year, what I'm going to show you is the amount he has to use. The first year he put 50 in, but he took it all out and he bought himself that fancy Corvette. So really, when we're doing the math from a return standpoint, we're not going to do a cumulative return on all of it because he's already used the money. The second year, he puts 10 grand in. In my scenario, he can take out $10,045 right off the illustration, folks. So if there's anyone looking on the compliance side, this is the illustration that we're looking at from this insurance company. And I'm looking at the column that says increase in net cash value. This illustration is run on my life, a 46-year-old, very healthy, non-tobacco person that put in that amount of money. Just to be clear, right? This is the illustration. The next year, he puts in another 10,000. That year, he takes out 10,538. The next year, he puts in 10 grand, and this is the fourth year, he takes out $11,051. The fifth year, he puts in another 10 grand, and he can take out $11,635. The next year, he puts in 10 grand, and he can take out $12,241. The numbers keep climbing, but let me just advance down to year 11. See, in year 11, Kenny can no longer put 10,000 in because of the MEC rules. So he can only put 2,500 into the policy. But for that 2,500 he puts in the 11th year, can anyone guess in the chat how much money he can take out? He puts in this is 11 years he's been doing this. He puts in 2,500 in the chat. Who can tell me how much money he takes out? Jim said 4,000, 3,500, 6,000. Now 15's overshooting a bit. We're close. So we're between Stephen and Jeff's number, 8984. Let's just do a recap. How many of you want a bank that when you go in and put 10 grand in, at the end of the year, you can take 10,045? You're all like, like my bank actually would probably give me more than that, right? None of you are super excited about this number. But if you passed away, your family would be really happy about that number, would they not? So here's the thing you got to understand. This is not a get rich quick thing. This takes time. Compound interest never happens quickly. And I want to be clear that we have to put some emphasis. If we're going to do this, if we're going to adopt this into our financial lives and our financial strategy, there's a couple things you need to do. Number one, we got to follow the simple rules. Be an honest bank. Okay? Always treat your money the same way you treat the bank's money. The second thing we got to understand is we got to put some value on the fact that one of the certains in life is that we're going to die. So is it better to have a death benefit or not have a death benefit? It's definitely better to have a death benefit if we die, because our family, Kenny's family in this scenario, would be really happy should something happen to Kenny in that really fast Corvette, just takes the turn a little too fast, realizes that 600 horsepower under the hood, just when you hit the gas accelerator around a turn, the ass end loses it, and he goes to a better place. His family gets $703,000 tax-free. Well, it's actually 703 minus the loan he took out, but that's semantics. Now, there's a cost for this. I want to be clear about that. The insurance companies don't work for free. Okay, the cost for this death benefit, and I could probably go into it, but let me just say it's a combination of term insurance and base. But I will say 550,000 of this 703 is term insurance. So how much did Kenny pay for that 550,000? $940 a year. So that means if he didn't have the death benefit, he would have an extra $940. This is what Dave Ramsey and Susie Orman are always complaining about. All that cost of insurance is so high. His base policy in this is only $45,000. So out of his total death benefit that he's buying from the insurance company that he's paying for, most of it is term insurance. And you guys would all think with what Dave Ramsey says and touts about term insurance, that Dave Ramsey would mail us a box of chocolates and a thank you card for doing what we do, because really we're using term insurance and we're using base, but it doesn't matter, the death benefit's the same. So nobody was excited about only making 45 the second year, but everybody's excited that if something happened, you're guaranteed that a death benefit's paid out to your family. Third year, 10 grand goes in, 10,538 comes out. So just pause, let's just do the math. What was his return that year on that money? He puts 10 in and he's got 10,538. So his net profit after cost of insurance, policy service fees, and everything is $538. So we take 538, we put it into a calculator. We divide it by the $10,000 he deposited that year. That is a 5.38% cash on cash return. The next year, 11,051. So instead of making 538, he made 1,051. So if we do the math again, 1,051 divided into 10,000 bucks, he made 10% that year. Actually 10.5%. Is everybody seeing what's happening here? This is cash on cash return. Okay, so we're just looking at the return each year for the money he puts in that year. We're not doing cumulative, because every year, if he put the money in and takes it back out, it doesn't change the math. Everybody understands that. If you're just going to put the money in the policy and you're going to leave it sit, I'm not going to lie, we're probably not the best fit for you, first off, because it's just not what we teach. But then you would use the cumulative return, because then you're just giving the insurance company the money instead of the bank and letting them hang on to it. The whole idea here is put your money into your bank and let's find somewhere for that money to go to work. Kenny luckily had a car loan on that Corvette. We could send the money out to pay off that car loan and recapture that 6.92% interest plus this right here that he's making. Now we got $1,635. I'm only going 1 year increments, folks. 1 year increments. That's all I'm doing. So 1,635 divided into 10,000. I'm just doing the same math you all can do. He made 16.3. Do you see how fast this happens? This is what Albert Einstein talks about. This is all he talks about. Compound interest. You are witnessing in front of your face, straight off of an illustration that I created for a video. You're literally getting the true numbers right here, right now. This was not rehearsed. Kenny wasn't called before this to say, hey, Kenny, you got that Corvette. Let's do a case study on here. It was all ad lib. We're just winging this. That's what the funnest part about this is. Here, now we made $2,241. We're only 5 years in. $2,241 divided into 10,000, 22.4% cash on cash. Nobody liked the numbers the first 2 years. And a lot of people would not do this because of the first 2 years. Oh, why would I ever put 50 grand in when I can only take 46 out? Like, oh, that sucks. I knew those whole lives were terrible. Oh, year two, I put 10 in and I only got 10,045 back. Who would ever do that? My bank pays me more than that. Short-sighted thinkers might as well just keep going to Bank of America, JP Morgan Chase, and keep doing what they're doing and belly aching and complaining. And they're probably the ones on TikTok always hating on everything that we say. But if you really start to think about this, I would guess all of you on this are going to live longer than 2 years. I bet you all of you are going to live longer than 5 years. I bet you all of you will live longer than 10 years. So bonus round, that 11th year puts in 2,500, and in that bonus year could take out, so 8,984 minus 2,500, which means, I don't even know how to do the math. That was how much he made net of all those pesky costs that insurance company charges you. So if we just do that, divided into, this is going to be a silly number, divided into 2,500, 259.36% cash on cash return. I don't know how else to put this to you. This is not about a product, folks. This is about a process, because this isn't all that Kenny makes. Kenny's also got all that 6.9% interest that he was paying to the car company coming back. Now, some of that he's got to give back to the insurance company. Absolutely. But he's making a spread. So he gets this plus the spread, plus the security that if he passes away too early, he gets a death benefit. Plus, here's the missing link that you probably aren't calculating, but Jimmy, the CPA on here, is looking at this. He's saying, wait, Chris, that's not the return. It's more than that, because this is a tax-free return. You don't have to pay tax on that. So to earn this return in your bank account, to earn any of these returns in your bank account, you'd have to do the net of tax return. Yeah, that's right. And that would be significantly more. Depending on your tax bracket, to earn 5% in a policy, you probably have to earn 7.2 and so on and so forth. I'll let the CPAs do the math there, but see, that's the thing you miss. This return, these returns, which are partly the dividend, partly the guaranteed interest, both, because we designed them within the MEC rules, are tax-free. Because remember, that dividend, as Dave Ramsey so beat up on it, is a return of those premiums that the insurance company didn't use. That's a terrible thing, but that makes them tax-free. This is what we do every day. I'm just showing it in a different way. And I wanted to really hit hard on the fact that a lot of people are getting hung up on a product. They're getting hung up on the returns of a product. They're like, oh, well, that doesn't make any sense. You know, and let me just go back to his. Let's just say, you know, it was 7%. Let's say Jimmy's loan was going to cost him 7%. He was only making 5.6. We did the math. Jimmy could make 3% and still come out ahead because of not the product, nothing to do with the product, because the process called the infinite banking concept.
Can you explain MEC when you mentioned MEC real fast?
So what they're talking about here, they want me to explain the MEC. Just like I don't want you to always get hung up on the product, I also don't want you to get hung up on the MEC. So what does MEC stand for? Modified Endowment Contract. I'm not going to write it out, but Modified Endowment Contract. This is an IRS thing, and it came to be in 1988. You can all look it up. In 1988, the IRS looked at life insurance, primarily whole life insurance. And they found that wealthy individuals, especially the oil tycoons, because if you remember back in the 80s, oil was nutty, kind of like it is today. The oil tycoons were making tons of money, and they didn't want to pay tax on their money. So before 1988, there was no MEC. So what that meant is a multimillionaire or a billionaire could take $50 million, just dump it into a single premium whole life insurance policy, and then have that $50 million grow. You saw the numbers we just did a second ago. So I don't know what that would go, but let's just say it goes to 51, 52 million. That means that these gains are all tax-free because they're inside of a life insurance contract. So by the IRS code pre-1988, you could do this. You could just dump $50 million in. You could dump $50,000 in. You could put any dollar amount you wanted into a policy. But unfortunately, this ain't 1988, because the IRS looked at that and said, whoa, hold on a second. Now, I know we did this tax code to benefit the wealthy. And folks, if you don't know this, the tax code does benefit the wealthy. Just look up 1041 tax reporting and ask yourself, how come you've never been told that you could do a 1041 tax return instead of a 1040? You could figure the rest out once you get to that point. But the tax code benefits the wealthy. So therefore, where were the wealthy people putting money? Life insurance, back when the tax code was written. The Rockefellers, the Rothschilds, the Carnegies, all of them used whole life insurance. They stored their wealth in whole life. Actually, the Rockefellers made their entire family banking system based on whole life insurance and trusts. They did it. So wouldn't it have just made sense that when they came up with the tax code, they wrote in there that life insurance could have tax-free benefits? That's right, because the death benefit's paid out tax-free. So if you're just using your death benefit while you're living, well, of course it should be tax-free. So now let's come to now. We no longer have the benefit of just dumping any amount. So the MEC rule says this. It's the MEC 7 pay is actually the technical term. And 7 pay means for 7 years. So for 7 years, what the MEC rule says is that we need to have a specific amount of death benefit on a policy for a period of 7 years in order to put a specific amount of cash into the policy in order for it to maintain non-MEC status. So depending on the death benefit, that will determine the premium deposit. And if we put more than what we're allowed to based on the death benefit that we buy, the policy will mech. And then all the tax-free nature of the life insurance contract will go away, and you'll now pay tax on it just like you would your bank account or your brokerage account. So back to that illustration that I talked about earlier, this policy that I showed was designed to hold $50,000 year one, $10,000 a year for the next 10 years. But then because of the MEC rules, because we no longer have to abide by them after the 7th year, what we do is we drop the death benefit. Because remember, we don't need the death benefit, and the death benefit has a cost. So that policy that we were doing, for Kenny's car, in the 10th year, when we put 10 grand in, we have 847,303 in death benefit. We started with 687. See how the death benefit goes up. But then in the 11th year, when we drop the term, because we no longer need the death benefit anymore, we get rid of it, the death benefit drops to 306,197. But this contract still remains tax-free. That's the MEC rule.
Awesome. We do have another question and answer show that we do every Wednesday at 4:30 Eastern called Ask Me Anything. You can watch that live streamed and interact with us either on YouTube or on Facebook. So go to YouTube at the Chris Naugle or at Private Money Club. And then you can also go on social media, Facebook, and find Chris. And we live stream it on there also. So you can come out every Wednesday at 4:30 for an hour. And then somebody's just asking, like, where do we get one of these policies? Who do we set this up through? What's that look like? So if you kind of want to lay that out, Chris, what we do all day, every day. So there you go.
Yep. This is what we do every single day, folks. And you guys can be the guests or the judge of this, but I will tell you, I think, and I might be biased, that we are the best in the industry at what we do. And you know why we're the best in the industry? Because this is all that we do. We don't sell term insurance. You don't come to us to buy a universal life. Don't ever come to us for an index universal life, because you won't like what we have to say and we won't be friends after that. We do one thing and one thing only, the infinite banking concept. So we definitely can build your policy. We can structure your concept. We even have a team, a back-end team called the implementation mapping team, where we design all of it out. So, like Eddie, when he wanted to buy, or Kenny, when he wanted to buy that Corvette, we'd map all that out for him. We'd do all the back office work at no additional cost. So if you're interested, and we'll put it in the chat, you can just email Snaggy, SNAGY, at chrisnaugle.com, and he'll send you a link to set up a call. And then we can walk through what it is you want, how you want to use the policy, and what goals you want to solve. And then we will help you solve them. We will never try to sell you anything. What we will do is solve a problem for you. And if we solve a problem for you, then you will ask us, how do I get started?
Drew was just saying it took a month and 6 days for his 1035 exchange to go through. And we see that all the time with like self-directed IRAs, which, by the way, we are doing a specialized training this evening at 6 p.m. Eastern also, just on self-directed retirement accounts. So we haven't even hit on that today at all. We're talking about today is all non-qualified funds. If you want to learn how to use your qualified funds, so IRAs, old 401ks, 6 p.m. Eastern, we're doing a special training with Greg Hurley on that. So join us for that also. But anyways, we see that a lot with self-directed IRAs, though, where we request the money to be rolled over from like Fidelity or Morgan Stanley or, a financial advisor, and they just drag their feet and it takes weeks and weeks. Why? Because those companies don't want to give that money up because they're controlling that money. And so when you do something like a 1035 exchange, you're taking that money from that company. So they just drag their feet as long as they can because they don't want to give it up. But it just goes to show you're doing the right thing there, Drew, by doing that. Let's see. So David said, what components of whole life policy does the insurance producer put into the policy to make this work? So
it's a combination of the term rider, the paid up additions, different insurance companies call that different things, and the base. I know a lot of insurance producers want to learn how to do this and they want the secret sauce. I give it to you. It's in that video on my YouTube. So please, if you go to my YouTube channel, all I ask, please subscribe. Don't be a freaking thief. Don't steal my content. Don't go into my YouTube channel and just start absorbing my stuff without subscribing. That's all I ask. A subscribe and a like, and you can have all the stuff. I teach everything how to do that. So you can learn how to do it. But I will tell you, even if you watch that video and you see how it's done, you will have a very difficult time designing policies the way we do, because there's a fine science, and I'm not trying to hold anything back, but there is a science to make these policies work within the MEC rules. God bless you if you can figure it out, and more power to you if you do, but that's how you would do it. So Mark Perry asked, and this is one that we've been getting a lot, which surprises me. Do the insurance companies have sufficient liquidity if there was a run on loans, kind of like a run on banks, which we already realized banks don't have the liquidity? Do insurance companies have liquidity? All of you can do the research on this and figure it out for yourself. You just look up the balance sheet of any of these giant mutually owned insurance companies, Lafayette Life, One America. You can even look at Mass Mutual, Guardian, Penn Mutual. But here's what I'll tell you. Banks don't use the same economic theory as insurance companies do. Insurance companies use what's called Austrian economics. Again, quick Google search of Austrian economics, you'll understand it. But really what it means is for every $100 that we make a promise to pay, a death benefit, okay? I want to be clear. Insurance companies are in the business of guaranteeing death benefits, okay? Life insurance. We must have $100 in assets to pay that death benefit. So think about that. For every $100 in death benefit, they have to have $100. Kind of simple, right? It almost makes sense. You're like, yep, same here. If I got a debt for $100, I got to have $100 to pay that debt off, right? But see, for banks, for every $100 they promise or do something with, they only need to keep 10% of that. So $1. So that's the difference, Mark. Banks are very different than insurance companies. Insurance companies could never really have a run on loans because insurance companies are guaranteeing death benefits, not cash values. So even if there was a run on cash values, the insurance company is guaranteeing death benefits, securitizing death benefit, not cash value. And you'll never, ever have as much cash value as you do death benefit. Actually, let me take that back. You would, but you got to live to 121 years old. And there ain't many people doing that.
Awesome. All right. So if you're allowed to make your policy payment 30 days early and up to 30 days late, does it make sense to do so early to start the compounding, or is it all set to the renewal date, whether you pay 30 days early or late in the grace period?
You can't pay 30 days early. We've gone through this many times. It really wouldn't make any kind of a difference. So when you set your premium up, what we can do is we can always backdate the policy 6 months. So a lot of people that want to get more money into the policies faster, that's what we'll do. We call it save age. We'll basically backdate the policy up to 6 months. A lot of times what that will do is save your age, because usually the insurance companies are looking at a 12-month block, right? If you're 45 years old, like I am now, when you get your policy, it's going to be 46. That example I gave, I'm 45, but my policy started in the year 40 or age 46. It's because I didn't save age, but I could have saved age and gone back 6 months early. So that would be a way where you could almost have your policy so that every year it's 6 months earlier than your actual policy anniversary because we saved that age. That'd be the only way to do that. But you can put money into these policies any way you want. The mode is up to you. You could do a dump in like I showed on that example. You dump in money up front, and then you could put money in monthly, quarterly, semi-annually, or annually. And every year, if you wanted, you could change that. But that's up to you.
And then somebody's just saying, can we give an example of how to use the cash value of the policy to pay your monthly expenses, if that makes sense, since you're paying interest to the general fund?
Yeah, I've got YouTube videos for every one of these things. Let me just see if I can't find it. I know in Nelson's book, he talks about that. Okay, I know he does, but it is not something that I support. It's probably one of the only things that I do not support because I think it's lazy. I truly do. I think, and I can't find it right off the bat. I think if somebody starts a policy and their goal with the policy is just to pay monthly expenses, groceries and diapers and food, your money isn't going to work for you. You're literally taking a loan to pay for expenses. And although, yes, based on the spread, you're doing well after a couple of years, like let's just say 5-7 years, it would make sense. You're literally saying to yourself, when you think like that you don't want to learn something new, that you don't want to find a better place for that money to go to work. How I would do it, instead of using my policy to pay for my expenses, I would take the money in my policy. We'll just use this example. I'd take this $10,045 and I would lend that money out. Okay. And I would lend that money out at maybe, let's just say 12% interest. Then I would take that 12% interest and I would use that to pay my expenses. You see, now my money is working for me twice. It's working for me once in the policy on the spread, twice by going out and working for me, making 12% in a private loan. Then I can use the interest I earn on that to then pay my expenses. And you could go multiple levels. So that is exactly why I do not like using policies for expenses. And I did an entire video on that, and I'll try to find it here for you guys in a second.
Doesn't it compound and grow a bit faster when you pay yearly versus monthly?
Yes, because think about it. I mean, when you do yearly premium deposits versus monthly, all the money goes in up front. Therefore, you start getting interest on all of it immediately. It's literally just mathematics. Where doing it monthly, you're doing 1/12 every month, and you're only earning interest and dividends on that 1/12. So of course, when you do all the money up front, the policy grows faster.
Does this still apply in Canada, or does the whole life insurance work the same?
definitely applies in Canada. Yep. We've got a partner up there, Jason Lowe, who does this up in Canada. It works identical. The tax rules are different. So up there, it's not tax-free like it is down here, but the policies work really, really well.
Jeff said it's so hard to get friends and family to see the light on this.
So stop trying. I don't talk to my friends and family about this at all. I just don't. It's a complete waste of my time. And unless a friend, and even friends all the time come to me and say, hey, you know, that thing you teach, I watched one of your videos, like, you know, can I help? I make it very difficult for them. Very difficult. Even Shauna, like, she's our director. Shauna listens to me every day through the wall and hears me talking about it. And Shauna actually, after, I don't know how long it took her, but after so long, got a hold of, you know, someone else on my team and had them do the policy for her, because I don't make it easy for people. I know I'm not going to chase you, and friends and family are just, to me, most times just a complete waste of time and energy. And I say that in all the best ways, but you can only help people that want help. So stop trying to help people that don't want help. And your friends and family, I don't know what it is. There's something to it. I'm sure there's been studies. They, for some reason, don't want advice from people that they love.
And that's, you know, a lot of what we do is it's just a different way of looking at money. And when you've been taught something your entire life and it works one way, and then all of a sudden somebody's like, actually, you're kind of wrong about it. And it really, you know, it's hard for somebody to change that mindset. I mean, that's why we use, like, if you watch the full presentation that we typically do, we always open up talking about like the video called The Backwards Bicycle on YouTube, because it really gets into how the mind works and how it's very hard to reprogram your mind to look at something you've known your entire life a different way. And that's really what banking is, because we're doing now what the banks do as opposed to what a retail consumer has done forever. And so it's a completely different way of looking at things.
Totally agree with that. But folks, I know, you know, we held everybody here. You know, we had well over 100 people on here today. We're 3 minutes past the hour. I do want to invite each and every single one of you for our 4:30 Eastern time, Ask Me Anything happy hour. We're at that happy hour. What we're going to do is we're just going to answer all the questions that we didn't get to here, or any questions that come up after this. So you can just join us. The best way to do that is go to my YouTube channel, subscribe, and then click the little alerts button. So if any of you have ever been on YouTube, it's right at the top. There's a little bell. It looks like a little bell. Just click that bell and it'll notify you every single week when we do the Ask Me Anything. But if you're just subscribed, you can just jump on from your YouTube or your Facebook. So that's how we stream on that. And then for any of you that don't know about it yet, we've got tonight's training, which you guys could all join us. And that would be, you know, about self-directed IRAs and qualified funds. It's going to be a really, really good training with Greg Herein. That starts at what time? 6 o'clock, I believe, 6 Eastern. So we got that. And also, we do have some seats left. If any of you want to come join us at the end of the month, April 28th and 29th out in Utah, the Private Money Club Money Tank event. It's an epic 2-day event. It's going to be the first of its kind, and it's going to be off the charts. The VIP sold out almost in a day. We still have some general admission tickets. You know, we got 120 seats we can sell for the thing. So if you guys are interested in that, we'll put that right in the chat right now. It's simple. It's privatemoneyclub.com/money tank. And you can grab one of the tickets. And so join us this month out in Utah for a really amazing event. And that is April 28th and 29th. Use that link. And for any of you that want to start your own banking system and create your own bank, then you can just go to the link that Stephen put up, book a call with him, and we'll answer any questions. But for that, Stephen, anything you want to say in closing?
No, man, I love it. It's, if anybody needs anything, just give me a shout. I put up my email. So just, you know, happy to connect and answer any questions. Help you guys set up policies, whatever you need. And looking forward to tonight's training on IRAs as well. And look forward to meeting I've seen a lot of you guys in Utah here in a couple of weeks. So if you're on the West Coast, especially, like, get there. No reason not to. It's going to be a fun one.
It's going to be a really fun one. So I'm looking forward to it. And folks, thank you all for your time today. Your time is the most valuable resource you have, and we appreciate you spending it with us. So that's a wrap for this episode of Wealth Webinar. We'll see you this afternoon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.